Yo, what is going on, guys? Welcome back to another YouTube video. I'm finally in the actual setup, not in my car anymore. In this video, as you can tell by the title, this is going to be part 2 of my entry model. And basically in this video, I'm going to be breaking down the role of our entry and basically the 4-hour candle, how its movement moves, and what we're actually looking for in that 4-hour candle for an actual entry. Now, this should sum up pretty much how the entire entry model is going to work for you guys, so you understand in the next videos to come. If you still haven't watched the last video, in the last video we covered daily bias. So the first step in the entry model was our daily bias, how we identify that. I'll give you a brief sum up of how we do that. Basically, we go to the 4-hour time frame. Since the 4-hour gauges the 4-hour move of the morning session in the New York session, so right after New York open, it's 9:30. Typically, I wouldn't trade 9:30 because I wait for all that volatility to go away, because 9:30 tends to be a very volatile time of the market since New York session opens. Wait till 10 a.m. What happens at 10 a.m.? 10 a.m. a new 4-hour candle opens. So that's why we look at that 4-hour candle, because that 4-hour candle is going to tell us what those next 4 hours, which is the ones that most people trade, at least for me. I trade that 4-hour session from 10 a.m. all the way up to 2 p.m. and usually find an entry within 10 to 11 a.m. So let me show you guys real quick a quick recap of the last video. Now, this should be a decently not too long video, so make sure you stick till the end. But daily bias, basically go to the 4-hour candle, identify the current trend. There were a couple things. So first thing is identify trend, and then the second thing was identify confirm order flow. Some people call it order flow. What I mean by this is imbalance respect. So are we respecting imbalances in the direction that the market is going in? And that'll give you another kind of confluence to go with your trade. So basically what I mean by that, obviously we're trending upwards, right? Y'all can see clearly we're trending upwards here. When we generate a fair value gap, are we respecting that? And as you can see, if I remove all of these, well, I'm not gonna remove them right now, but you can see we have one right here. I can move this box to that one, as you can see right here. And if we drag it out, we're respecting it. We didn't get a single 4-hour close below it. We got a ton of wicks, which is a good sign, and we're still making structures to the upside. So we'll be kind of looking at this one right here, I believe, today, and breaking that down. So just structure, uptrend, confirming order flow, bullish fair value gaps are being respected. We didn't close below any of them, so we're bullish. Okay, so that's pretty much that. Now, we do have a completely free Discord. If you want to see every single trade that me and my team take, it's not just me, other people. We have a complete breakdown of every single trade we take, why we take it, when we take it. And then we also have a completely free course that can introduce you to all the concepts, and it's completely made in-house. If you want to join the free Discord, chat it up with us. We do giveaways, and we're going to be hosting tournaments on there in the future. Go ahead and join. Link is in the description if you want to start trading funded accounts. Now, other than that, once you join the free Discord, hit me up in the DMs. By the way, I'll respond. And let's get right into it. So, role of the 4-hour candle. So the first thing we're going to cover here is, first of all, anatomy of a candle. No, don't skip yet, because this is going to explain what we're actually looking for here. Now, if you look at pretty much any single 4-hour candle or any candle in the market, just because this is how price moves, you will get an open, right? So how candles move, let's say we are looking at a bullish candle. I'm going to draw it out. So a bullish candle, we'll get its open. Typically, it'll chop around for a little bit. Oh my God, what is that? It'll chop around for a little bit. So boom, boom. Let me extend this out a little more. Extend this out a little more. Okay. But before, if we're expecting the candle to close up top, if we're expecting a candle to close up top, then we're expecting a candle to look like this, right? Look like this. But what happens first? Before we manage to close up there, typically we'll put in a nice bottom wick. So candle will open just like so. We get a low is going to be put in after we open. It doesn't matter. We don't know how big, but typically there will be a low put in. It is very rare that we find a candle that doesn't get a bottom wick, because that just means that as soon as 10 a.m. hits, it just rallied in that one direction without going back down. We get the open. We form a high. So a high gets formed. and then we finally close. So that's how a candle works, right? And you may know this type of candle as a open, low, high, close candle. So this is a bullish candle, open, low, high, close candle. We'll be focusing on this. A bearish one is just the opposite. So we open high and then we close low, right? So no, we make a low and then we close, sorry. All right, so in this example, we're gonna be looking at a open, low, high, close candle. And what this tells us is typically, if we are expecting a bottom wick, why are we entering without that bottom wick being created? And what do wicks usually do? Wicks usually take out liquidity or fill imbalances, right? Imbalances, fair value gaps, if you want to think about them in this way, the way I like to think about them, why I use fair value gaps, is fair value gaps are just areas where, first of all, it's internal liquidity, right? And we know the market likes to move from internal to external and from external to internal when it's in a trend until it breaks that pattern and goes into the opposite trend and then continues that pattern again. So by understanding how the candle works, you can look for the candle open, understand that there's most likely going to be a manipulation in play. Manipulation being obviously that bottom wick. It'll be a red candle at first, but we're expecting a green candle. So first, let's go ahead and break down why are we expecting a green candle and basically the draw on liquidity. So second step, draw on liquidity. All right, so let's go ahead and remove this. Now let's go ahead and break down the draw on liquidity. So when we're looking to see what type of candle are we most likely to get in the day, that includes, our daily bias. So we've already established that we're bullish. All right, I made a complete video breaking down daily bias. If you still don't understand it in the last video, just go to it. In this video, we want to understand our draw on liquidity and our place within it. So the draw on liquidity, what does that even mean? It's where we think price is most likely headed to next in terms of a large liquidity pool grab, right? So when we're looking at a bullish trend, let me draw out another nice trend for you guys. If we're drawing out a bullish trend, we're right here. If we are to continue the bullish trend, what does that mean? By definition, continuing a bullish trend means new highs are getting put in. If new highs are not getting put in anymore, it is not a bullish trend, right? So what does that mean? We put in a high, we retrace, we put in a new high breaking this high, we retrace, we put in a new high, we retrace. Where do we need to go next minimum for it to still be an uptrend? So since we're in an uptrend, we're expecting price to just continue because we haven't had any signs that it doesn't want to continue yet, right? So since we're playing with the trend because trend is our friend, minimum the next place for this trend to continue being a bullish trend is it has to take this out by at least a tick, right? For it to become a bullish trend. We don't know how high it's going to go, but we know if it's going to continue to be a bullish trend, we need to tap this high at least. That's just the way I like to think about it. Okay. So let me remove these. Let me remove the circle. So most likely thing to happen is for us to take out that high. Again, we don't know how far up it'll reach. We don't even know if it will reach there, but we're just playing by the odds. And most likely thing is when we're in an uptrend is that we're headed to the next high after a retracement. And why I like fair value gaps is because typically fair value gaps appear after the inside of the distribution leg after a retracement. So right here we retrace, right here we distribute to the upside, and typically you'll see fair value gaps in that leg up creating a new high because of all that volume and strength that we needed to create a new high. So typically we'll see a fair value gap, for example, like right here, and price will retrace into it. And that's why I like them. So they're just good areas for price to retrace into because first of all, you can say that there's a lack of orders or orders that are still need to be filled there. Whatever way you like to think about it works. It's just an area of high probability retracement and continuation in my eyes, right? So let me go ahead and remove all of these things from the screen here. And let's actually draw on the chart to really understand what the heck I'm talking about. And I'm currently in the process of running like a bunch of back tests on all of 2024. Those results will come out inside of the free Discord. So link in the description if you want to join for that and see what variation of my strategy actually works the best and what you like with proof. Screenshots of every single trade are going to be getting comed out. Pause. Screenshots of every trade are going to be coming out. And a whole sheet with info on ratios, win rates, percentage, etc. So join the free Discord if you want to see that, and just shoot me a DM and I'll get you the info. Okay, so we drew it out on a little stick chart. Let's now draw it out on a natural chart. So finding the draw on liquidity. We've now established, and these are the steps to actually finding the draw on liquidity. So first thing, establish trend. Boom. What are we? We are bullish. Amazing. Number two, which is basically, there's only one more step after number two, so there's going to be three. So number two is, have we retraced yet? So retrace, identify, retrace, identify, retrace. So identifying a retrace obviously is typically when we dip back into a fair value gap or a, a supply zone, demand zone, whatever you want to call it. So obviously a demand zone right here that used to be a fair value gap. A lot of people are against, identifying this as a fair value gap because it already got filled a million different times. But once it gets filled once, then you could just identify it as a strong demand zone, or you can still just identify as a fair value gap. That's just how I see it, because obviously we still respected it. We never closed. And what's amazing is you can identify retraces in the market so beautifully with fair value gaps, because you can just see when good retraces happen. Because a lot of the time they'll act, like the market will literally retrace into fair value gaps like to the dot, and it's beautiful. So they work for me, and that's why I like using them. Let me show you real quick this example. So we've identified trend, we're bullish. Identify a retrace. So we're looking at this 10 a.m. candle. Again, the 10 a.m. 4-hour candle is when we're going to trade. It doesn't matter when you trade. Technically, this works on any 4-hour candle because candle anatomy and time is fractal. So multiply this into whatever time frame you want to trade on, all right? So we're bullish. Now identify the retrace. The retrace is going to happen. We're going to wait first. So we want to remove this. Boom. So what do we want to see first? So we don't see this candle yet, right? We don't see this candle yet. So what do we want to see? We want to see a retrace. So we get the retrace. It is this huge wick, bro. If you look at this huge wick, we just wicked out and took out this low right here, okay? And respected it and still ended up closing above this fair value gap. So the market has completed a nice retracement. What does that mean? Now that we've completed a nice retracement in the actual move, the majority, the big move, now we're ready for the inside retracement of that 4-hour candle. We're not expecting something huge like this because we've already taken out major sell side liquidity. Now we're going to that next 4-hour candle and expecting to see a beautiful, nice little dip down before coming back up. As you can see, it actually ends up tapping straight into that fair value gap, but for actual entry, we use a smaller time frame fair value gaps, and I'll show you that a little bit sneak peek in this video if you stay long enough, but mainly in the next videos to come out. So the actual draw on liquidity now. We've identified we have a retrace. So now that we have a huge retrace in the actual overall trend, major retrace, we are most likely ready to identify where the hell is price likely to go to next. Okay, and that's going to be, oh, what is going on? I drew a box. Third step in finding the drawn liquidity is identifying resting high/low liquidity. What does that even mean? I don't even know why I typed it like that, but basically just identifying that last high in the trend. So what is the last liquidity, that level of liquidity or area level high that hasn't been taken out yet, right? So the first one we're most likely headed to after this retracement is the first one that we just created. This one is the safer one. We created this one more recently. It failed to take this one out. Now, there's going to be a lot more orders here in liquidity since this one failed to get up there, right? So as time goes on, more liquidity builds up, especially if a move goes up like this and basically taunts that level of liquidity and then fails to take it out. So this level is mostly going to get ran through. But the ultimate level that we're really looking for in this structure is the peak of this last swing up, which is going to be this level right here. Right? That's where we're really aiming for this next 4-hour candle to hit. And look what ends up happening is a crazy move to the upside. So, what do we want to see here? We want to now go down into the trenches of this 4-hour candle and understand on the lower time frame what this all means. Okay, so now we've identified, we understand the anatomy, drawn liquidity. We're gonna go back a little bit into the anatomy of a candle, but we're gonna go back in a different form, anatomy internally. So we're gonna dive inside of this candle, pause, and see what it's really made out of and what these wicks and highs and lows actually look like on the lower time frame. So we can drop into the, I remember this trade was specifically taken on the 1 minute, so we can just drop down into the 1 minute time frame. First we'll drop into the 15 minute and let's identify where we're at. Should be right here. Okay, 10 a.m. 10 a.m. is right here. All right, cool. So 10. All right, so we're on the we're on this time frame now, and we want to understand where this or what this candle looks like inside. So basically, once we're inside, identify a 15-minute gap. Again, this is just talking into the future videos. So again, fair value gaps are high probability places for price to retrace into. As you can see, once we form this 15 right here, price retraces into it right before 10 a.m. And then if we go down into 10 a.m. into the 1 minute now, down into the 1 minute, and let's go back over there. Oh, where is it? This way. Y'all, where'd it go? Oh, right here. We can understand it a little better here. What is happening at 10 a.m. So as we near 10 a.m. here, we don't get a bit as big of a wick down. But as soon as 10 a.m. opens, we open, tap into the fair value gap again before heading out, and then start building bullish structure, right? Now, what do we end up seeing? This is the bottom part of the move, the manipulation leg down. So we can draw this out. In this example, it happened a bit before 10 a.m. But we still put in a nice little bottom wick. And what ended up happening, this is basically like a bottom wick, manipulation leg, right? We open right here, right above the fair value gap. And then the rest is obviously the body. Now, taking entries off these, I'll give y'all a little sneak peek. So basically, steps to take an entry off this is we want to catch the distribution leg. So this is a pretty obvious manipulation leg down. We fill this fair value gap almost completely. And then shortly after, we end up changing state of delivery. This is, I'm giving y'all the sauce right here, bro. Hold up. So right here, we have this level. We end up closing above it on the 1 minute since we're delivering off of a 15-minute bullish fair value gap here. And then wait for a retest of that level. get a long position. Retest obviously happens right after. Stops stops at the low. And then obviously, you know the rest. I typically go for a 2R, and then you can see what happened after that. But yeah, candles, that's pretty much the understanding of 10 a.m. and the draw on liquidity. So the draw, obviously, we want to catch a manipulation, and then the distribution should take us to that draw of liquidity. And oh, it's actually here. Wrong example. Hey, I'm giving y'all 2 examples. I was wondering where it was at. So let me see. There you go. I'll just use this example. I'll give y'all another example here. So alright, so 10 a.m. Oh yeah, this one's clean. This one's actually clean. Alright, so right at 10 a.m. 10 a.m. opens right here. We open right here at this level. We're expecting what? A manipulation leg down first, right? So first a manipulation leg down. In that manipulation leg, we want to see it tap into a fair value gap or an imbalance, so we can fill that, right? So here we have a 15-minute fair value gap that was created from back there. It's on the 15-minute. Now, what do we want to see? 10 a.m. opens right here, right? 10 a.m. opens right here. And then now it's below the camera. 10 a.m. opens here. We expect a leg down first, which we do. Leg down. We tap perfectly into that fair value gap. And now we're ready for our change in the state of delivery. And where does that actually happen? That happens right here. So after we tap down, we're waiting for that change in the state. What was the last leg that caused that low to be put in? The last movement down. Technically, you could also say it was this one because this candle closed red. Then it most likely opened red, tap down here before switching back up. But for extra confirmation, enter up here once we close up here. I don't really like entering on the same candle. So right here we get a close. Oh, draw it out. And then for a long, enter in on the retest. So here's the level. Here's when we break above it. We close up here and then we retest it perfectly here. So entered here. Here also would get a retest. It taps into discount over entry. Stops at below that last low on the change in state. And then this gave a nice jump up. And then actually never stopped it out, which was nice. So yeah, that was that one. And as y'all can see, that draw on liquidity got met. That first level that we identified previously, and then that second level completely got ran through and destroyed in that one leg up. Because we identified a strong retracement, that huge wick. So the market already took out major liquidity. So now all we're waiting for is an internal manipulation leg on that 10-minute candle. We get it, a little tiny one, just so we can ride the rest of the move. All this is just waiting for our right time to get in line for the ride. Basically, that's pretty much it. So because let's say we would have entered, oh, we think it's going up here, and you enter up here when it's already going up, and then you lose your bread. Or if you would have entered up here because you thought it was already going to go up and it's only 9:40. See, at 9:30 we open. Oh my God, we went down, took out liquidity, enter right here targeting those highs, and you would have gotten swept. So just wait. I just wait for the 10 a.m. Get a little manipulation leg, wait for the little bottom wick to get put in, and then we catch the ride up. And that's pretty much it, boys. In the next video, I'll be covering identifying which imbalance to find for the 10 a.m. candle to retrace into for its wick. And then after that, we'll be covering the actual entry, being a change in the state of delivery or an inverse fair value gap, or both. And then after that, we'll also cover risk management and how I manage risk once I'm in these positions for the entire entry model. So if you guys are interested in learning about this quicker, go ahead and join the free Discord. Link is on the top of the description. And thank you so much for watching this video. I'll be dropping a video every single day.